Assalamualaikum everyone and good evening. This is JUNAID Khalid, your course facilitator for F7 Financial Reporting. Okay, today in this class we are going to start the standard, that is IAS 10, events after reporting period or reporting date, and one of the most important standard right now. Remember, IAS 10 is never tested independently in the paper. Whenever we have seen in the past, whenever the examiner has tested this standard, this is along with the IAS 37. So there is a combination of IAS 10 and IAS 37, that is provision, contingent liabilities and the contingent assets. So first of all, in the initial phase we are going to start this standard IAS 10, and then soon after this standard we'll continue with the IAS 37. Okay, let's begin with IAS 10, that is events after reporting date. First of all, we need to understand the timeline of the management's financial reporting or the management's accounting process, how the accounting process for company comes to an end. Okay, let's take an example. Let's say there's a company and the financial year of a company ends on 31st of December 20x8. Okay, that is the end of the financial reporting period. On that date the management is going to prepare the financial statement. Management is going to prepare the financial statement. The first point comes to the light, that is financial statements are prepared by the management. Management has prepared the financial statement, and as we all know that there are 5 main components of the financial statement, like profit and loss account, statement of financial position, that is the balance sheet, cash flow statement, statement of changes in equity, and notes to the accounts. These are the 5 main components of the financial statement. But let's keep it very simple, and we just talk about the 2 main components, that is the P&L, income statement, and the balance sheet. Okay, management has prepared the financial statement, that is P&L and balance sheet, at 31st December 2008. Now, these financial statements have been prepared by the management, and no doubt, please remember that all of the transactions that arose during the period of this accounting year was definitely conducted by the management or the board of directors. Definitely, the authorizations were given by the board of directors and the management. Simply, the transactions were recorded by the board of directors and the management, and finally the financial statement is also prepared by the board of directors or the management. Now there is a serious concern on behalf of the shareholder, and the shareholders is not gonna to trust on this financial statement. These financial statements are not that trustworthy. So now what's the next step? The next step is we need to verify, we need to check it out, we need to verify whether the said financial statement is correct or incorrect. If there is any fraud, if there is any error which has not yet been discovered, so it means now these financial statements need to be inspected, and the person who will inspect that financial statement, we all know that is known as auditor. Now auditor is gonna to inspect this financial statement. I use the word inspect. It means auditor is gonna to examine this financial statement, and the examination of this financial statement, I said examination or verification or inspection of financial statement, that is known as, that process or step is known as audit. That process or step is known as what? Audit. It means, what is audit? Audit is the examination, verification of financial statement, that is known as what? Audit. Okay, now that audit will be conducted by the person that is known as auditor, and definitely I'm not going into the depth analysis that who can be the auditor and what should be the qualification for this one, but he should be a very independent person. Okay, now after the year end of this financial statement, now the audit of that particular financial statement will start. It means auditor will start to examine this financial statement, or will start to evaluate this financial statement, whether it is correct or not, whether it is free from fraud or error. Okay, now as the audit will begin, and the day will come approximately 2.5 months or approximately 3 months. In a 3 months period, let's say in a 3 months period, the audit will be completed. And let's say let's take a very tentative date, 31st of March 20x9, is it 31st December 20x8, and that is 31st March 20x9. Okay, at 31st March 20x9 the audit was completed. On this date the audit is completed, audit is finalized, and once the audit is completed or the finalized, it means there will be a financial statement known as what? audited financial statement. Now that is the audited. Earlier it was a simple financial statement. Now that financial statement is known as what? The verified financial statement, audited financial statement. Okay. Once the audited financial statement is ready and prepared, now the board of directors meeting will be organized. There will be a board of directors meeting, let's say on the 10th of April 20x9. 10th of April 20x9. Now the board of directors meeting is conducted, in which the board of directors are there, and this audited financial statement is presented. Audited financial statement is presented. Board of directors will quickly evaluate this financial statement, and then board of directors will give the approval. Board of directors will give the approval. Let me use another terminology for this one. Board of directors will give the authorization. I repeat, board of directors will give the authorization or the approval. Now the approval or the authorization for what? Approval or the authorization for the issuance of this audited financial statement. Authorization, approval. The approval has been given by the board of directors for what? Approval for what? Approval for the issuance of audited financial statement. Audited financial statement to the members, or we can say that to the shareholders. Now the board of directors has given the approval, the permission, or given the authorization. Now that audited financial statement will be issued to whom? Issued to the shareholders or the members. Now the question arises whether the financial statement that was prepared on 31st December 2008, if this financial statement was dispatched to the shareholders. No, that financial statement was not dispatched to the shareholders. Why? Because there is no use of it. That financial statement was not trustworthy. Shareholders are not going to trust this financial statement. Reason being, number one, all of the transactions that arose during the period of accounting period were done by the management. All of the transactions recorded was recorded by the management, and on the basis of these transactions, the financial statement was prepared by the management. It means all of the done was done or performed by the management or the board of directors. Definitely no one is going to trust this financial statement. So there was no use to dispatch this financial statement to the shareholders. So we waited for this one. We waited for that date, and we conducted the audit for this financial statement. And after the completion of the audit, now that audited financial statements, board of directors has given the permission and the authorization and the approval. Now yes, this financial statement can be dispatched to the shareholders, to the masses. Now that audited financial statement will be dispatched to the masses or the shareholders or the members of the company. Now there's a date. Now there is a date on which financial statement was prepared. There is a date on which the financial statement was prepared. That was the 31st December. That date is known as date of reporting. That date is known as what? The date of reporting. Now what is date of reporting? Date of reporting is the date at which the financial statements are prepared by the management. There is another date at which that is 10th of April. It could either be a 31st March as well. For example, the date on which the audit was completed, and on the same date the board of directors has organized the meeting, and on that particular date the audited financial statements were authorized for the issuance to the shareholders. So in our example, it's 10th of April 20x9. On the date at that date, board of directors has given the permission or the authorization for the issuance of that particular audited financial statement to the shareholders, and now that date is known as the date of authorization. That date is known as what? The date of authorization. Now what is date of authorization? Date of authorization is the date at which the audited financial statements are authorized for the issuance to the shareholders or the members of the company. Now that particular standard for which we are starting right now is completely completely rotating in between these two dates. That is the date of reporting and the date of authorization. Now just hear the title of that standard: events after the reporting date, and the complete title is before the date of authorization. When we will read the explanation of that standard, so the complete name of this standard is events after the reporting date, events after the date of reporting but before the date of authorization. Now what is the scope of that standard? What is the scope of this standard? Let me tell you the scope of this standard. Now complete timeline is in front of you. Okay, IAS 10 specifically tells you that how to account for, listen to me very carefully, how to account for all those events. I repeat, how to account for all those events that arises, how to account for all those events that arises in between the date of reporting and the date of authorization. I repeat again, how to account for all those events that arises after the date of reporting but before the date of authorization. How to deal with those events that arises after the date of reporting but before the date of authorization. This will be explained by the IAS 10. Now the question arises, a very good question that comes to the mind. What? For example, if the reporting date is ending on 31st December, if any event, let's say there was a fire in the warehouse, for example, one of the customers has gone bankrupt, if any of the event that arises after the date of reporting, now the question arises, why there is a need to consider this one? Why there is a need to consider this one? For example, if the accounting period is ending on 20x7, 31st December 20x7, 31st December 20x7, if the accounting period is ending on 31st December 20x7, and any event that arises on 31st December or after the 31st December 2007, that's, let's say, in 2008. Now the question, or that first thing come to your mind, is that if event is arising in 2008, there is no need to consider, just record the transaction in the period ending 31st December 2008. Why we need to consider this one? There is no need to consider, just record that particular transaction in the next or the following accounting period. But no, IAS 10 clearly states that, listen to me very carefully, important word, important sentence. IAS 10 clearly states that, no doubt, the event is arising in the year 2008, but that may relate to 2007. Listen to me very carefully again. The event definitely is arising 2008. No doubt, event is arising in 2008, but that event may be related to 2007, and if that event is related to or connected to 2007, it means that event should be recorded in the year ended in the financial statement of 2007. So that is the scope of IAS 10. IAS 10 clearly states that if any event that arises after the date of reporting but before the date of authorization, how to account for these events, how we are going to record these events, what treatment should be adopted for all those events, that should be dealt according to IAS 10, that is events after reporting date. And now that standard is quite easy. Reason being, why that standard is easy? Reason being, there are certain examples that has been given by the IAS 10, and we need to follow that one. We must have a very grip on that particular examples. If we have gone through and we have understand all these examples, definitely we can answer the examiner's question. And most of the time, it is seen in the past that mostly examiner tests the scenarios related to that standard, and most of the scenarios or the questions that has been tested in the past are from the examples that are given in IAS 10. So it means we must have a very good grip on those examples that has been given by the IAS 10. So that is the scope of IAS 10. IAS 10 deals with the events that arises after the date of reporting but before the date of authorization. Okay, moving ahead. Event that arises after the date of reporting. Let's say 31st December 2009 is the date of reporting, and the date of authorization is 31st of March 2010. Okay, that is the date of reporting and the date of authorization. Now any event that arises in between these two dates, how should we account for? So IAS 10 states that any event that arises in after the date of reporting but before the date of authorization can be categorized in two different ways. Number one, that is the adjusting events. Few events will be recognized as an adjusting event and few events will be recognized as non-adjusting events. It means there are two types of events. As per IAS 10, there are two types of events, that is adjusting and the non-adjusting events. Okay, now what are adjusting events? Events that arises after the date of reporting. Events that arises after the date of reporting. But before the date of authorization. Okay, that's confirmed. Events that arises after the date of reporting but before the date of authorization. And the second important thing is evidences, or we can say that hint, and the other good word is indicators. Let's simplify more. Symptoms of which existed at the reporting date. I repeat. What are adjusting events? Events that arises after the date of reporting but before the date of authorization, and whose evidences, that is too technical, whose hint, indicators, symptoms that existed at the reporting date is known as what? The adjusting event. It means any event that arises after the date of reporting, but there are certain indicators, there are certain hint, indicators, symptoms, evidences that were available at the date of reporting is known as what? The adjusting event. So that is quite complicated. That is very technical. We are unable to get it. So let's go for the first example that has been given by the IAS 10. Okay, let's try to understand this one through an example that is given by the IAS 10, and the example is for settlement of a court case. Okay, let's go through the example, and hopefully after getting this example that will be quite easy for us to understand that what actually the IAS 10 is. Okay, let's assume the date of reporting. Although the word date is quite interesting. Okay, for many the word date is quite interesting, but after going through this standard as much of time we will use the word date, and I think at the end of this standard you are gonna to hate this word. Okay, the date of reporting, again the date 31st December 2000 and let's say 7 is the date of reporting. Okay, now during the course of accounting period, one of the customer or the supplier has filed a suit against the company. Okay, one of the customer or supplier has filed a court case or the suit against our company. Okay, and definitely we had some breach of contract or for any consequences, for any non-compliances, one of the customer has filed a court case against a company. Okay, and claiming a penalty, definitely, and claiming a penalty of some amount. At the date of reporting, when the management is about to prepare the financial statement, don't forget that whenever the financial statements are prepared, on while considering the different accounting principles. And the most important accounting principles that we regularly follow and the most commonly used, that is the accrual concept. Definitely no accounts are prepared while ignoring the accrual concept, and second one is the prudence concept. Okay, before we move on, let me recall the accrual and the prudence concept, the theme, the central idea of both the concepts. Accrual concept, the central idea of the accrual concept is that you record the expense irrespective of the payment. Never ever have an argument or the plea that I'm not recording the expense as if because I have not paid that amount. No, that is not the case. Accrual concept, the matching principle clearly states that expenses are recorded even though if it is not paid, because we record expenses when they are incurred, when the expenses are incurred or arise, and once you have taken the benefit of that particular, or once the expenses are incurred, you need to recognize it irrespective of the payment. It means the main or the core idea of the accrual concept, that is the expenses are recorded even though the payment is not made. Okay, the second one is the prudence concept states that if you think that if there is any future loss, expected future loss, you need to recognize that future loss. Expected future losses are recorded. Expected future losses are recorded. Let me give you the example. You have done it in your past exams. For example, if there is a provision for bad debt, allowance for bad debt. Now, what is allowance for bad debt? We are doubtful. We are doubtful whether we will recover or not the receivable amount. It means you're doubtful. You're not confirmed. You're not sure. So, if there is an expected loss, what standards or what accounting treatment suggests that you just record that expense or the loss as if there is any expected future loss, just record it. Just record it by now. So, it means there are two main concepts that need to be followed while preparing the financial statement. That is the accrual concept, and the other one is the prudence concept. Okay, these are the two main concepts that need to be applied. While I was preparing the financial statement, that is at the date of reporting 31st December 2007, I was considering that there is a court case that existed at the reporting date. Is it? And now I was considering whether to recognize that penalty amount or not in the financial statement. Point number one that comes to my mind, that I haven't paid that penalty amount, so why should I record? And another doubt or the confusion that comes to my mind, that penalty has not yet been announced by the court or the judge. So why should I record that penalty? These two questions are very relevant. But answer of these two questions is that the accrual concept, and second one is the prudence concept. Is it? Because the question number one, why should I record the expense even though I haven't paid the amount? The accrual concept states that we never wait for the payment. Second question is, why should I record the penalty expense amount even though the penalty has not yet been announced by the court? So the answer of this question is the prudence concept. Prudence concept never tells you that you wait for the loss to arise. If you are expecting that there will be a loss, just record it right now, right away. Just record that expense. It means, should I record the penalty? Yes, I should have recorded. I must record this amount of penalty. I must record this amount of penalty if it is expected. Okay, but what the company's management did? They did nothing. Yes, they did nothing. They didn't make any provision or they didn't record any entry for this one. Okay, let's move on. Financial statements were prepared, income statement and balance sheet, P&L and balance sheet, but no expense or no adjustment was made in this regard. Okay, perfect. Let's move on. Soon after the date of reporting on 14th of Feb. Okay, nice, interesting, huh? 14th of Feb, the most important date. I said date, not 14th of Feb. Okay, 14th Feb 2008. They decided. 14th Feb. They decided. Who? The court. Court decided, and court made a decision. And decision means there was a settlement. There is the settlement of court case. Decision means there is a settlement of court case, and court awarded a penalty of let's say $3 million. $3 million. Court awarded a penalty. Awarded means court rewarded a penalty of $3 million, and I lost this case on 14th of Feb. Now there is an event. After the reporting date, but definitely before the date of authorization. Is it? Date of reporting. After the date of reporting, there's an event. And what is that event? That is the settlement of a court case. After the date of reporting, that is $3 million. The penalty has been imposed. Now, any event that arises after the date of reporting but before the date of authorization, to whom should we refer? We're going to refer this situation to IAS 10. IAS 10, come on, wake up. There's an event. There is event after the reporting date, but before the date of authorization. IAS 10 definitely wake up and said, now just try to identify whether it's an adjusting event or the non-adjusting event. Any event that arises after the date of reporting will either be adjusting or the non-adjusting event. IAS 10, how we are going to identify whether it's an adjusting or the non-adjusting event? So IAS 10 explains that any event that arises after the date of reporting but whose evidences, hint, indicators and symptoms were existed at the reporting date. Just go towards the reporting date and highlight and identify, try to identify whether there were any evidences, hint, indicators or symptoms were available at the date of reporting related to that penalty amount. Adjusting or non-adjusting, whether there were any evidences. Okay, let me go back to the date of reporting. Yes, at the date of report, let me close my eyes. Yes, at the date of reporting, the court case was existed. And yes, accrual and the matching principles, accrual concept and the prudence concept, they fully guided me. Yes, if there is any expected loss and even though you have not paid, you must have to record that amount, but I didn't record it. I didn't took the estimation from my legal expert or the advisor. So it means the evidences of that event, the hint, indicators of that penalty, the indicators, hint and evidences of that penalty was existed at the reporting date. Yes, at the date of reporting, that penalty was existed. That penalty was there. The evidences and the hint and the indicators of that penalty was there, but I ignored it. I didn't record any amount. I didn't prepare any entry for this one. It means IAS 10 states that if the settlement of a court case after the date of reporting but before the date of authorization, but make sure the court case existed at the date of reporting. What I said, the court case existed at the date of reporting. It means the evidences were there, but you ignored it. It means that is the adjusting event. Now what to do? That is, you need to adjust. What does it mean? You need to record that expense. Although I told you earlier, although that event arises in 2008, let's say 2008, yes. No doubt that event arises in 2008, but that relates to the 2007. We cannot ignore it. We cannot defer it for the next accounting period. We need to record that expense in the current accounting period, in the recent accounting statement or the recent P&L or the balance sheet. So accounting entry will be recorded. That particular financial statement need to be adjusted as this financial statement is under process. Is it? That the audit of that financial statement in process. It means that financial statement has not yet been finalized. And the most important thing is that financial statement has not yet been dispatched to the shareholders. That financial statement is still in control. So just record that amount or the penalty. So how we want to record it? That is penalty expense debit and penalty payable credit with the amount of $3 million. That is the penalty rewarded by the court. I hope this is clear to you all. Okay, one more thing. Let me make it more easy for you. For example, if there is an accounting period that ends on 31st December 20x7, okay, that is the date of reporting at which the financial statements are going to be prepared. Okay. No court case was there. Okay. Soon after the date of reporting, on 10th of January 20x8, one of the customer has filed a suit against the company. That is, the court case proceedings has been started, and definitely customer is claiming for penalty amount. Okay. And on, let's say again, 14th of Feb 20x8, court settlement or the adjustment was made, and again there is a settlement of court case, and court rewarded you a penalty of $2 million. $2 million penalty was rewarded by court. Okay. That is again, event arises after the date of reporting. Yes, the event that arises after the date of reporting, but before the date of authorization. It means there is an event. There is an event that arises after the date of reporting. That is the settlement of a court case. Court rewarded you with a penalty of $2 million, but before the date of authorization. To whom should we refer now? IAS 10, IAS 10, come on, wake up, wake up. Okay, IAS 10. If there is an IAS 10, definitely will tell you, identify whether it's an adjusting event or the non-adjusting event. How we are going to identify? Look it out whether at the date of reporting, whether there were any evidences or not, whether there were any hint indicators related to that penalty. Okay, let's try to look it out. At 31st December 2007, at the date of reporting, there were no indicators for that penalty. There were no symptoms, hint or indicators for that penalty. It means, yes, that situation falls under the IAS 10, but IAS 10 now states that if there were no evidences at the date of reporting, now that event will be considered as what? The non-adjusting event. That event will be considered as what? The non-adjusting event, as there are no evidences at the date of reporting. There were no hint or indicators at the date of reporting. It means this will be considered as a non-adjusting event. Is it clear to everyone? So in this particular example, I gave you the example for both the adjusting as well as the non-adjusting event. So settlement of a court case after the reporting date. But point to be noted that the court case existed at the reporting date. This will be considered as an adjusting event. Now, many of the students, one of the question that comes to the mind, that what if we made an entry on date of reporting? Is it? That comes to your mind. Okay, at the date of reporting, there was a court case and we made an entry for this one, and we made a penalty entry for the amount of, let's say, 1.5 million. Estimated amount of 1.5 million. Now what's next? And the court rewarded you a penalty of 3 million. Now how are we going to account it for? How are we going to take it? How are we going to adjust this one? So wait for this one, will be discussed in IAS 37. So that's why I told you that IAS 10 and IAS 37 both are interlinked. They are connected with each other. Soon, inshallah, in that particular standard, we'll discuss this one. That what if you have made any amount, or you have recorded any amount or expenses or the provision, and subsequently if that amount varies or that amount is changed, subsequently discovered that that amount was not accurate or a new estimate was found. So how are we going to adjust this one? We'll inshallah look it out in IAS 37. So that was the first example that was given by IAS 10. That is the settlement of a court case after the reporting date. But remember, the court case existed at the reporting date. Okay. Another example that is given by the IAS 10 for the adjusting event. Another example that has been given by the IAS 10. Example 2, and that is the example of bankruptcy of a customer. Bankruptcy of a customer after the date of reporting. Okay, before we start this example, try to understand the procedure of bankruptcy, that is the liquidation. Whenever any customer or any party that goes into bankrupt, or they don't have personal or official resources available to pay off to or settle the obligations or debt. So what they do, they move on towards the court. They go towards the court and they file for the bankruptcy. They file an application for the bankruptcy. Okay, once the customer is in the financial difficulties, for example, they went to the court and they filed for the bankruptcy, that kindly please, they are basically requesting, application means they are requesting the court to please declare us as a bankrupt. What does it mean? That we don't have resources to pay off the obligation or the liability, so that people will not tease you anymore. Okay, now once you have filed this in the court, or once you have filed the application in the court, now the court will assign that duty to the official receiver, and official receiver will try to identify your let's say the hidden assets, and will try to discover all your assets, and will find all your hidden assets, and will try to sell out all those assets. subsequently in the second or the third phase, the official receiver, after selling all your properties and everything, he will try to settle the obligations. He will try to pay off your debt to the creditors in a proportionate way. Definitely all creditors will not get the full amount, and the amount will be distributed to the all creditors in a proportionate way. For example, a creditor might get 30% of the payment, or 40% of the payment, or the 40% of the due amount. Okay, once this will be done, and after paying off all the available resources, now the court will reward you with the certificate, that is the certificate of bankruptcy, that is known at that date. We will say that the customer has gone bankrupt. Okay, now why I told you the whole story for the bankruptcy? Reason being, bankruptcy is not the process of over the night. Definitely that full process, that customer was in the financial difficulties, stage 1. He went to the court and he filed an application for the bankruptcy, stage 2. Stage 3, appointment of the official receiver. Stage 4, that is to identify the hidden assets and the resources. Stage 5, the sale of that particular assets and the properties. And last stage, that is the settlement with all the creditors. It means that whole process will definitely be completed in a very long duration of the time period. Let's say year or 2 year or 3 year or 4 years. Definitely sometimes it takes years of years. Okay, now let's come back to the example given by the IAS 10. For example, there is a reporting period ends on 31st December 20x7. That is the date of reporting at which the financial statements are prepared. Okay, on that date, definitely company will be preparing the balance sheet, and in that balance sheet, the trade receivable, the account receivable arising of $5 million. Okay, $5 million is the trade receivable or the account receivable. On that date, account receivable having a $5 million, there is an account receivable, and customer and the company made no provision for the doubtful debt or the bad debt. No adjustment was made. Okay, soon after the reporting date, let's say on 14th of March 20x8, one of the customer, let's say Mr. A, from whom we were about to recover, let's say account receivable balance was 0.5 million. Okay, $0.5 million was the receivable from Mr. A. And the news broke out that Mr. A, one of the customer, has gone bankrupt. On that particular date, 14th of March, that particular customer is now declared as bankrupt. Now, particular customer is declared as bankrupt. That customer is bankrupt now. It means if the customer is bankrupt, that full amount of 0.5 million is a loss towards the organization. Okay, now what should we do? An event that arises after the date of reporting, but again before the date of authorization, to whom should we refer? Let's move on towards the IAS 10. IAS 10, please wake up. There is an event, one of the customer has gone bankrupt and we are not able to recover any amount from that customer. Whether the event is adjusting or non-adjusting. Simple question that will be asked by the IAS 10. Identify whether the event is adjusting or non-adjusting. So how are we going to identify this one? In that particular example, IAS 10 clearly states that no customer can gone into bankrupt over the night. No customer will be declared as bankrupt over the night. It means it's a process of years. It's a process of months. It means at the date of reporting, the financial difficulties and financial instability of that customer was existed at the date of reporting, but you didn't made any provision for doubtful debt. You didn't made any bad debt provision. Your credit control department was ineffective, because of which no provision for doubtful debt was made. It means the loss was existed at the reporting date. Loss was existed at the reporting date, but you didn't made any entry for this one. Now it means the end. Why? Because the ultimate and the sole reason is that no customer can go into the bankrupt over the night. No customer can go into bankrupt over the night. This is a process of months and months. It means that loss was existed at the reporting date, but you didn't made any provision for this one. You didn't work out for this one. You didn't look at the customer instability or the financial instability. So what to do next? Recognize this event as an adjusting event, and entry will be made for this one, that is P&L debit and account receivable credit with the amount of 0.5 million. Adjustment will be made in the current year accounting statement. It means the financial statement that is under consideration. So that is the second example of adjusting event given by the IAS 10. I hope this is clear to you. Inshallah, in the next video, we'll continue with this standard and we'll continue or finish up with all the remaining examples. Thank you so much. Allah Hafiz.